Hello and welcome to Main Street Money Moves, where we are demystifying economic news so that you can make more informed decisions about your money. Let's talk about the Federal Reserve because it just wrapped up its meeting for June and the message is quite clear. Interest rates are likely heading higher. 9 of the members on the Federal Open Market Committee predicted that interest rates could go higher by at least one rate hike, while 8 members said that they thought interest rates would stay where they are. But they do agree that inflation has been running too hot for too long. The Fed's preferred inflation gauge, known as the PCE index, jumped 3.8% in the month of April compared to the same time last year. That is the hottest inflation rate in roughly 3 years. And it's not just higher energy prices that's behind the surge in inflation. Food prices are up, insurance is up, travel costs are up, rent is up as well. Now, the Fed's main tool to target inflation is its key Fed funds rate. Right now, that rate stands at 3.5% to 3.75%. Now, if the Fed does go ahead and raise interest rates, then that is likely to cause demand to come out of the economy. And when demand comes out, prices typically go down, so inflation cools. The Fed is facing a conundrum. It wants to lower inflation without hurting the labor market. New Federal Reserve Chairman Kevin Warsh believes that he can do so. He says that you don't have to sacrifice job growth in order to lower inflation. The markets, however, are not so sure. They are already pricing in a rate hike as early as September and the possibility of another rate hike in the month of December. If there are any doubts of where the Fed is headed, the Federal Reserve's statement that came after the meeting made it quite clear. First of all, they dropped any mention of lower interest rates or an easing bias. And then in a press conference, Federal Reserve Chairman Kevin Warsh reiterated that the Federal Reserve, quote, "the committee will deliver price stability." So now what does all of this mean for you and your money? The Federal Reserve's interest rate influences the lending rates that we all pay for when it comes to mortgages, car loans, and credit card payments. So if the Federal Reserve is going to raise rates, then those lending rates are going to typically follow higher. The only question is, how much higher will they go? So that means that if you're in the market for a big ticket item that you might be buying, you might want to pay closer attention to what's happening with interest rates, because it very well could mean that you are paying higher interest rates for whatever loans you take later on down the road. For more easy to understand business news, please like, subscribe, and share, and follow me on all the social media platforms. Remember, my goal here is to demystify financial news so that you can improve your financial wellness.